Hi, it's James Gerrish, the primary contributor to Market Matters, and today I'm joined by Adam O'Connor, who's from BetaShares, the capital markets team there. And today we're going to talk about ETF investing, some of the major themes that we're across this year in 2018, and how to gain exposure to them. So thanks for joining us, Adam.
My pleasure, James.
Three major topics we want to speak today around is around a large correction happening in 2018. How can we potentially get exposure to it? How can we hedge portfolios around that? I want to speak to you about potentially investing or trading around the oil theme and around the gold theme. We're active investors in both of those areas of the market. And I want to also speak to you around the currency ETFs that you got exposure to. So one of the key themes that we've been writing about recently is around the potential bottoming of the US dollar. It was up last night, and we think that's a theme in 2018 that is likely to play out. So first of all, around hedging against the market correction, I understand BetaShares have got a number of products around that. Can you give us an outline of what they are and how investors can get exposure to them?
Yeah, we do have products exactly for that. We call them our Bear suite of products. Our Australian Equities Strong Bear Hedge Fund, BBOZ, and our US Equities Strong Bear Hedge Fund, BBUS, are actually two of our larger funds from an average daily traded volume perspective.
So one tracks the Aussie market, one tracks the US, the S&P 500?
Exactly right. So depending on the market exposure or the directional view you want to take, BBOZ, our Australian fund, essentially gives you magnified leverage short exposure to the Australian market. BBUS, our US fund, will give you the same over the US market.
So they're leveraged plays?
They are. So the way that those funds work is they're effectively index futures based products. So what we do is for the Australian market, we'll effectively be selling SPY futures. For the US market, we'll be selling S&P 500 futures. And the way we do that leverage is effectively we allow the funds to fluctuate on a daily basis in a range between effectively negative 200 to negative 275%. If they do go outside that range, we'll rebalance them back to the middle. Reason we do that obviously is because if you're invested in say BBUS, for example, the US market just keeps going and going and going. You might end up in a situation where you've got a 3 to 4 times leveraged exposure. Likewise, if you're looking at having a magnified hedge where you don't have to outlay much capital to get a reasonable hedge, and the market does fall in your favour, then you might only end up with 1.5 times exposure, and so we will pull that back into the middle.
So in simple terms, so you've got leverage, we understand that. Have you got unleveraged exposures to both of those? So a simple investor out there wanting to hedge your portfolio of shares?
We do have one. It is Bear. So we've got BBOZ, BBUS and Bear. Now the Bear's only over the Australian market. Because it's futures based, we still have to allow it to fluctuate within a range, but that's between 0.9 and 1.1.
So you can hedge an equity portfolio dollar for dollar using the Bear fund.
You can hedge an equities dollar for dollar, or obviously you can hedge with the 2 to 275 leverage.
Okay, moving on to what we're seeing in the US dollar. As I may mention, the US dollar last night started to move higher. It's been very, very soft in 2017, going against the market consensus, which was for a higher US dollar on the back of rising interest rates. Our view at Market Matters is around the US dollar bottoming around these levels, so going along the US dollar. How do we get exposure to it using ETFs?
Yeah, definitely. We're definitely starting to see some more interest come into these funds over the past week as the Aussie dollar's gone back over 80. I guess our largest fund in the long USD trade is our US dollar ETF, USD. That's pretty straightforward in its construction. It's physical US dollars on deposit with JP Morgan Chase in the US. Any interest earned on those funds accrues to the benefit of investors. That fund's sitting at about $500 million in AUM.
So it's getting, US dollar rallies 10%, that fund will go up 10%.
It's basically it's designed to go 1 for 1, obviously, before fees and expenses. The other way you can do it is we have introduced what we've called our Strong US Dollar ETF, Yank, much in the same way as I described the Bear funds, but with the AUD US dollar. So it allows you to go long USD in a range of 2 to 275 times, by selling AUD USD futures.
Okay, moving on to oil and gold. We've held the long-term view that oil was likely to go to 70 this year. That view's played out to a large extent. We're sitting sort of that 65 handle at the moment. More upside in our view in crude oil. How would we get exposure to crude oil on both sides of the ledger?
Yeah, we don't actually have anything on the short side of the ledger, but you know, if you wanted to play that long view and you thought WTI was going to move closer or even go over 70, and do that through the commodity itself, we do have a crude oil index ETF, OOO. Basically, the way that fund is designed is it's designed to track crude oil futures. The other way you might potentially do it, which I think is probably more interesting to Australian equities investors, is we do have a global energy companies ETF, ticker on that's Fuel. So what Fuel does, Fuel holds the 50 largest energy companies globally, ex-Australia, on a currency hedge basis.
So you get exposure to the big names. You don't have to worry about the currency. It's listed on the ASX.
Absolutely. Big names. You got your big seven. Your Shell, BP, Chevron, Exxon, Total, etc. And those are going to give you that inherent exposure to movements in the oil price. I think the interesting one with Fuel in particular is when you look at the way that Australian investors have traditionally got exposure to movements in the oil price. It's been through the Australian energy majors. So it's been through your Woodies, your Santos, your Oil Search. When we're looking at this fund, we actually looked at the correlation between Fuel's index, as in a basket of global energy majors, and their correlation to oil price movements versus the Australian domestic exposures. And you actually, in most cases, end up with about double the correlation to oil price movements by buying global energy majors through the Fuel index than you do through the domestic exposure.
When you want to finish off with views on gold, how do we play gold? As subscribers know, we're active around our gold allocations. If we think the US dollar is going to rally, obviously gold inversely tracks what the US dollar is doing. So we're looking on the shorter side of gold throughout 2018. How do we play it through ETFs?
On the short side of gold?
Yep.
We don't actually have a short gold product. We've only really got the long exposures there.
Okay, so you can buy gold.
So you can buy physical gold. Our ETF holds allocated gold bars in Vault, and we also have a global gold miners ex-Australia product, much similar to Fuel, but global gold mining companies.
All right, a great overview of ETF investing. It's interesting at this point in the cycle that thematic investing is gaining more attention both here in Australia and abroad, and investing through ETFs can give you a low cost exposure to it. It's really important around liquidity. ETFs are reasonably liquid. Expense ratios, management expense ratios are important to consider, but it's also important to consider the simplicity of investing, and a lot of Beta Shares products are through the ASX, listed on the ASX. As always, have a great trading week. I'll speak to you soon. Bye for now.